In this episode, I answer 7 questions, all related to buying gas stations and how to understand the numbers and if the stores are really making money or losing money. I think you may find this episode helpful if you're in the market to buy a business. Here, I analyze some sales numbers and see which ones are making money and which ones are not. Stay tuned.
Welcome to the one and only Gas Station Business 101 podcast, where you can learn all the secrets about how to start and operate a gas station business successfully and make money. This podcast is brought to you by the good folks at CSB Academy Publishing Company. And now, here is your host, Shabbir Hossain.
Welcome to Gas Station Business 101 podcast. I am Shabbir Hossain, and this is episode number 59. This is the show where we discuss how to start, run, and grow a gas station business successfully. And I give you an inside look at many real-life case studies so you can follow and be successful in this line of business. First, my apology, a sincere apology, once again, for not coming up with an episode sooner. I was busy with few projects and had to put the blog and the podcast on the back burner once again for just a bit. But I'm back and hopefully I will be posting new episodes sooner rather than later. I still haven't forgotten about the episode I promised you where I will share the new profit and loss statements from that subject store that I helped buy some investors about 14 months ago. And I know I promised you that in the last 2 episodes in a row. And in all honesty, half of the episode has been recorded already and I was waiting on some more P&L data. And when I received them, I got busy with something else and again had to put that in the back burner. So it is in the process and hopefully I will post that episode sometime soon, I promise. Now, as for this episode, I had to do this one first because I have had way too many emails lately where many of the blog readers and podcast listeners have been asking me various due diligence and profit and loss questions. Most of them are looking to buy a business and they have many questions. They're giving me some numbers to analyze and to tell them if these numbers jive with how the profitable gas station should look like and if those numbers make any sense for that matter. And I emailed them back and I told them that I would analyze them and I would answer them via podcast because sometimes it is a lot of writing if I want to answer some of these via email. And to be honest with you, I did not find the time to do so and there were way too many emails. Some of them I replied back with if they were asking a simple question that I could answer in just a couple of lines. But most of these these 7 especially, that I will answer in this episode are similar in nature. So I grouped them together. There are a few others that I haven't addressed yet. But these are the ones that are similar in nature, so I have decided to answer them in one episode. That way, any of you want to learn, once again, how to do due diligence, this is the way to do it. And this is where you can learn how to analyze some of these numbers. So let's dive right in. Question number 1. And before I go into the question, one thing I have decided to do, which is to hide the names of the sender of these emails because most of these people are looking to buy a station. So I don't want to mention their name and give out any details of the location or city or state. This way their privacy is intact. All I'm going to do is share the numbers and analyze some data so everybody can get benefited from this without revealing any information that may hurt their chance of buying the business. Fair enough? Let's start. First question. I'm going to read the question first and then I will answer. The question reads, I need your advice about the valuation for the store based on the following information. I've cut out some of the other things that the person has said, so I'm just going to give you the gist of the email. And as it reads, he gave me some sales information and some expenses. And if you are driving or not in a way to write things down, just listen and you will understand. You don't have to get a pen and paper and write down the numbers, because I will do that for you. So here are the numbers. Inside sales, $55,000 a month. Outside sales, which is fuel, 25,000 gallons a month. And he claims that the seller told him that inside sales, they generally make 27% profit margin. So if you calculate 55,000 times 27% margin, the total comes to $14,850 gross profit on merchandise sales. Now, as far as fuel, the seller told him that it does 25,000 gallons a month at 10 cents a gallon. Now, that's a very general statement that they make 10 cents a gallon, because often, like people like us who are in this business for many years, we know that this is a very standard general answer, that we make 10 cents a gallon, but not necessarily. There are times you make much less, there are times you make much more, but if you average that out, it should be around 10, but sometimes in some stores, the average can be as low as 4 cents a gallon. And in some stores, it can be as high as 15, 18 cents a gallon. So let's take the seller at their face value at first and see what it comes out to. So at 25,000 gallons at 10 cents is very easy. You multiply that and it's $2,500 a month profit from fuel. Then the store sells lottery. So wherever they are, they sell lottery, and the seller says the lottery commission is $4,000 a month. That is, in my sense, my view, it's a little high. So the store must be selling quite a bit of lottery, because the lottery people do not pay you very high commission. It's, if I'm not mistaken, we don't have lottery, but I know lottery people usually pay you 1.5% to 2% commission on the sales of lottery tickets. So that store must be a busy store selling a lot of lottery. And from ATM, the seller claims they make $200 a month, which in my opinion is very low. But anyway, so if we add whatever the seller has provided as far as the sales number and the profitability, the gross profit for that store comes to $21,550. How? Well, $14,850 profit from inside merchandise. You add $2,500 from fuel, $4,000 from lottery, and $200 from ATM machine. The total comes to $21,550. The email sender also says the owner is absentee in this store. He or she is not in the store regularly. But the store has capability to open a deli with a grill, meaning a full deli. But the store doesn't have deli right now. But it is capable of having one, okay? And the store is located in a small town, mostly neighborhood business. That's a good thing. Now, let's look at the expense. The rent, he says, is $5,000 triple net. NNN, triple net. What does that mean? It means $5,000 is the base rent. Plus, the buyer has to pay for the common area maintenance, which most stores we all have to do if we're leasing the store. Then the insurance, the property, the casualty and whatnot, the insurance has to be paid by the leasee or the guy or the person who will be renting the place. Additionally, they have to pay the property taxes. So it's the T&I, tax and insurance, has to be paid in addition to paying the base rent, which is $5,000. But he did not mention what are those numbers. Those numbers could be as high as $2,500 a month if the store is in a state or in a municipality where property tax is very high, and if the store is in a natural disaster prone area. You know, there are coastal areas that have high probability of flooding or being affected from hurricane and such. Usually in those areas, the property insurance is quite a bit high, double or sometimes triple, depending on where that store is. So we don't know those numbers. Okay, we'll move on without those numbers. Then they said the utility is $1,300 a month. Credit card fees are about $1,000 a month. Payroll is $2,400 a month with 2 full-time employees. And other expenses are about $500 a month. So the total expense comes to $10,200. Low, definitely. Okay, so let's look at the net profit of this store based on the numbers that the seller has provided. Net profit should be, let's talk about take the gross profit of the store based on all the sales, which is $21,550. We will deduct that all the expenses from that total, gross profit total, and the total expenses for this store was $10,200. So if you deduct that from that $21,550, you come up with $11,350. That's the net profit the seller is claiming. Asking price for this store is $225,000. And this person is asking me, what should be the price? What price should he offer to the seller? Okay, before I answer the question as far as the price goes, I think you need to find out a few other things. And as I said, this episode will be all about due diligence. So for your safety, I think you need to verify a few of these numbers. For example, if the store is making 27% gross profit on inside merchandise, and if you follow the process I outlined in various episodes where I talk about how to figure out gross profit of merchandise sales based on category sales like beer, soda, cigarette, and all that. I can't think of the episode number on top of my head, but if you go through the list of my episodes, you will find it. Also, I outlined it in my book. If you have it, you know how I calculated that. But I don't think you need to buy my book for this. You can simply listen to my episode where I outlined it. And if you're on my mailing list, you've received that email where I show a clear calculation of how to come up with exact numbers of profitability from merchandise sales just by looking at their selling price versus what they're buying or how much they're paying for. For example, if they're paying for, let's say, pack of Marlboro, they're paying $5. And if they're selling it for $6, you know exactly how much profit margin they're doing based on that cigarette cigarette price difference, selling versus buying. Similarly, you can pick out 1 or 2 candy bars and see how much they're buying versus how much they're selling. Similarly, you can do that with soda and all the other departments. And then you calculate profit margin from each category and then tally it up and see if they're really making 27% profit margin or not. Ideally, I think most gas stations nowadays are making anywhere from 23 to about 25, 26, as high as, 27. But since this is on the high end, I really would like to take a look at that. I mean, when I say I mean you should look at it and verify that that is what it is. Next, gasoline profit. It's very simple to figure that out. Ask them to see some fuel invoices and take a look and see how much they're paying per load of fuel. And when you look at that total, you need to make sure you break it down to regular, plus, and premium. And usually you should concentrate on regular only because that's the lowest margin product which sells the most. So once you know how much you're making on regular, you know you're making more on plus and premium, but they don't sell as much. So as long as you can see that you're averaging at least 8 cents or more, let's say you pick out 2 invoices from last 2 weeks ago and then 2 invoices from 2 months ago and take an average of these 2 and see what their profit margin was on fuel. But for that, you need to have a report or something like if you have their daily closeout report, most daily closeout reports that prints out of a register shows their fuel prices for that day. So once you have an invoice to know that they paid $1.75 a gallon, and you saw on the Z report that they were selling it for $1.89, then you know they were picking up 14 to 15 cents a gallon for that day. Similarly, you can randomly pick out few other days and see if those gross profit margin on fuel were anywhere from 6 to 12, 15 cents. Then you know that the 10 cents average is correct or not. Very important. Then other question I have on that, or concern rather, which is lottery commission. And that is very simple. If you can talk to the seller and ask to see a lottery commission report, because most lottery are run by the state government, and they usually provide you with a statement at the end of the month when they transmit or remit the commission check or fund rather, because most of these are done electronically. So they will email you an invoice or a statement that outlines how much commission you have earned for the previous month. And if they can show you, if the owner can show you randomly 2 months, let's say you say, show me last June and this past December, then you can see an average and say, okay, they're making $3,700 on 1 month and $4,200 on another month. So yes, the average is $4,000. Then that is fine. ATM, I wouldn't worry about it. It's $200 a month. So once you check that, then you come down and question the expenses. I see some red flags in the expense report. For example, rent is $5,000, no red flag, but we need to find out how much are the other things attached to this rent, the triple net part, where you need to find out how much taxes and how much insurance is. So let's assume it's $1,000 extra on top of $5,000, which will make your rent $6,000 a month, and that's fine. Now let's take a look at utility bills. It says average $1,300. Running gas stations for this many years, I have not seen a station that has $1,300 utility bills all combined. Because most of the time, a gasoline station, a gas station, especially this one, if it has enough room for a deli and grill, I'm assuming that this store is about 22 to 2,500 square footage, which is a standard size for most gas stations. With canopy, with at least 2 MPDs or 2 fuel dispensers where 4 cars can pump at one time, which is a very typical gas station in rural areas, since this store is in rural area. And if the store is operating at least about 17 to 18 hours a day, which is 6 to 12, which is the standard operating hours for most gas stations, then electricity bill, the power bill alone should be anywhere from $1,700 to $1,800, as high as $2,200 to $2,400, depending on how many canopy lights you have, how many equipments, how many coolers, how good or bad your insulation is, and all that factor comes into play. But let's assume that it's on the low end and it's a $1,700, $1,800 power bill. Then you have to add your internet or phone, which is roughly around $150 at the lowest, whoever you get. Then the trash pickup service. For commercial trash pickup, you cannot find anybody less than $100 a month. And then you have either natural gas and, of course, water. Let's say, since the guy mentioned that it can be equipped with cooking facilities, I can imagine it may have natural gas, but let's say they don't. They have water service because the bathrooms will need water. Without water, a gas station cannot survive. So if you add water bill of $100, you're looking at $1,800 plus $150 for phone, which makes it $1,950, another $100 for garbage, trash pickup, which is $2,050, another $100 for water, which would make it $2,150, and let's say alarm service and whatnot, at least $2,200 a month minimum. So there is a discrepancy, in my opinion, when it comes to utility bills. Now, as for credit cards, $1,000 seems low, but again, some local neighborhood stores where some people may use more cash in some areas than credit cards. So I will not question as much, even though, in my opinion, stores with similar sales, I've seen credit card fees nowadays should be around $1,500 to $1,800. Okay, but the biggest concern I have for this store is payroll. You mentioned the payroll the seller gave you is $2,400. Now, let's assume the store is open 18 hours a day, 6 to 12. If you put one person behind the register at each shift, let's say the store has 2 shifts, and the person gets paid close to minimum wage. You can't hire people with just $7.15 or $7.25 nowadays. But let's say you did find somebody very decent for $7.50. Now, once you add payroll taxes, it usually adds about $1 to each hourly payroll. So let's say you hired somebody at $7.50. I safely add $1 for each hour for payroll taxes. So your out-of-pocket expense would be around $8.50. And if you multiply $8.50 by 18 hours each day, it comes to $153 each day for payroll expense. And if you multiply that by 30, means 30 days to a month, your payroll should be right at $4,500, give or take a couple of hundred. But this seller tells you the payroll is $2,400. How is that possible? Somebody most likely is not getting paid for working here. As I said, a 18-hour store with single coverage, meaning one person behind the counter, nobody else is in the store. Your payroll still should be anywhere from $4,500 to $5,000, not less than that, unless somebody's working for free, which is not really possible. So you need to look very hard at these numbers and verify and see where the problem is. Now, once you get the real numbers, and let's say the total expense comes to $15,000 or $16,000, and the profit margins are staying the same, means he did not lie or she did not tell you anything wrong, and they are making 27% profit margin, then you will see that $21,500 gross profit, when you deduct it from all your expenses, real expenses, which are not $10,200, which will be more like $16,000, maybe even higher depending on the triple net part, then you will see your real profit, net profit, is not $11,300. It will be more like $4,000 to $5,000. And once you know the real number, then you need to figure out how much should you pay for a business that makes you, let's say, $5,000 a month. And if the asking price you said $225,000, it is hard for me to tell you yes or no, it is a high price or low price based on few things. For example, if the store is located, let's say in some parts of Florida or somewhere in New York or somewhere in California, where people buy marginal store, the store that's hardly making any money, they still pay almost $500,000 for a store. But now, if it is in an area, in a rural state, then yes, $225,000 for a store that is for lease, making only $5,000 a month is high. So geographically, the price can vary widely. And a lot of people in bigger cities think, hey, at least I'll be working for myself. And if I don't get paid hourly, at least I can save the payroll dollar and that will be my income. So yes, for let's say if the store is in Los Angeles, in a rural area of Los Angeles or outer side of Los Angeles, there is no rural part of Los Angeles, then I would say the price is low. But if the store is in Mississippi, for example, then the price is high. But more importantly, remember this, you will not remember if you pay $20,000 more or $30,000 more for a store or less if you are making good money out of that store. But if you're not making good money out of a store, regardless how much you paid, that business becomes a pain. Let's say you're losing money every month. Then even if you got the store for free, losing money is never fun. So more than pricing, you need to look at profitability. That is where I put all my emphasis in. I don't care if I have to pay $20,000 more for a store that is making good money, or I know it can make good money, because that income will make you forget pretty soon that you paid $20,000 extra. So that is where your concentration should be. So I will not comment as far as how much price you should offer this seller. Instead, I would advise you to go and look and see if these numbers are true or not. Once you know the real numbers, and once you know the net income, forget about what you can grow that business into. Let's forget about that for now. You need to figure out the way it is running now, would you be making money? That is more important. Once you know, yes, I will be making money, then once you get in there, you can start improving and making more. But remember this, at first, your concern should be, as it is running, will I be making some money or will I be losing money? Okay, moving on to question number 2. This person sent me the email with at least 4 questions in one email. So I will read each and answer and move on to next part of his question. He writes, Shabbir, here are few questions. Please note that I do not have prior experience. So how can I convince how can I convince them, and I would imagine he's talking about oil company or sellers, that I am serious, and are there any training provided by gas companies? Okay, let's address that first. Well, if you are going to talk to oil companies, jobbers that own multiple stores and they're looking to lease one or two, they don't always look for people that have years of experience. If they know an individual or if they see an individual that is serious about business and understands the basics of a business and has good credit standing and let's say a good job or some type of stable job, that they can see that this is a stable person. Because gas station is a business, as I've said many times, that it doesn't require any special skills or any special training. It's all common sense. This business is truly all common sense approach. So as long as you can talk and explain that you are an individual with serious intentions and seriousness about business, then I'm sure you can convince them that you are an ideal candidate for them to trust and lease a business to you. And as for training, yes, there are trainings available. When I became a dealer, a corporate dealer for British Petroleum, BP Oil Company, they sent me to their home office, which is in Cleveland, Ohio, and I was trained there for 3 weeks. I had to attend school and take exams and all that. And then they certified me as authorized dealer for British Petroleum. Those programs are not readily available anymore because most gas stations are now owned by or operated by jobbers and not directly by oil companies. But if you want training, there are trainings available. So if you're approaching a jobber and you ask them if there are trainings available, let's say the jobber you approach is a jobber for Shell. I'm sure that jobber can put you in touch with Shell Oil Company and their training department, where you can sign up, and most likely you have to pay for your own expenses, but the training most likely will be provided to you for free. And it can be a week or 2 weeks of training, and they teach you and train you about the basics of gas stations and fuel cells and how to handle various aspects of business. So yes, there are trainings available, but it has to be found through a jobber, and you cannot just go and ask to get trained by an oil company. Okay, second question he asked, I will read the question. He asked, when buying just the business, I mean just goodwill without real estate, how do I make sure that my interest is protected? For example, if I buy a lease for $500,000 and pay $16,000 a month rent, what if the lease is for 2 years and after 2 years the owner does not want to renew the lease? How can I make sure 100% that I will not lose everything? Very good question and very scary one. Anytime you're leasing a business, there are certain degree of risk involved, obviously. But one way we mitigate that risk and minimize that risk is by reading the lease and making sure that there are no language in there that can jeopardize my investment. For example, I have read a lease many years ago written by a small oil company that said either party of this lease can cancel the lease within 30 days written notice. And the person who signed it didn't even read it. 3 years into that lease, he receives a certified letter from the landlord says in 30 days he will have to vacate the store because the landlord has found somebody else to sell it. Typically, most lease says that the landlord will provide the first right of refusal to the person who's leasing the business. Meaning, if the landlord for any reason decides to sell that property, he or she should offer the leasee the first option to buy that property at the price, a market price, or the price that he or she is getting offered. But in this case, there was no language such as that. So this person that received that letter had to finally vacate that store in just 30 days, even though he paid quite a bit of money to get into that store. So obviously, you have to read the lease and understand what you are reading. And a lot of times, this legal languages can be written in a way that a normal person cannot understand exactly what they're reading. And for that very reason, a lot of times we go and seek help from an attorney. Hire somebody and maybe they will charge you $500 to review a lease, but that is one investment. Very small, is well worth it. But to address your concern, which concerns me, that you can even imagine paying $500,000 goodwill to somebody and pay as high as $16,000 rent, and they may offer you just 2 years lease. Regardless how good that store is, if I'm making $20,000 a month, I still may not sign that lease, knowing that lease is only for 2 years, unless the lease clearly states that the goodwill money I am paying this seller, which is $500,000 in your case, will be refunded to me as long as I return the store back to them in the original condition, meaning my sales, my store, all the equipments that came with the store, everything when I take the store from them is operational, and at the time of returning the store should be the same condition or better. If that's what's written on the lease, you can go forward with it. If not, I wouldn't sign that lease for anything, because anytime you're paying $500,000, you need to make sure that lease is favorable to you and your investment. So the lease could be, the only way somebody can pay that large sum of money, if the lease says, this is a 15-year lease with 2 5-year option, or this is a 5-year lease with 2 or 3 5-year renewal option at, let's say, 2% increase in every 5 years. Or it can say that the inflation rate, every 5 years when they renew the lease can go up or down based on the inflation rate. Whatever that is, it could be 2%, 3%, 4%, as high as 4%, but not more than that. So you know that you will be operating that business for 15 years. So at minimum, you should have a lease for 15 years when you're paying that large amount of money. If not, you can invest or pay down payment $500,000 and buy a store with real estate. I wouldn't even think about paying $500,000 to somebody for a lease just for 2, 3, or 4, or 5 years even. No, because that means after 5th year, if they get you out of that store, you paid $100,000 per year to operate that store. And I'm sure after all the expenses are paid, you didn't even make $100,000 per year from that store. So any which way you look at it, this is a losing concern and a very, very bad deal. Okay, moving on to his third question. As far as tax benefits are concerned, at the end of the year, which option is better, buying or leasing? I would appreciate if you only focus on the tax benefit part, since you have already talked about pros and cons from the other angles. For example, let's say the gas station A is leased with goodwill, paid by on-hand cash, and gas station B is bought with real estate with a bank loan. Let's say both gas stations have exactly same per month profit after all lease or loan payments are paid. Now, at the end of the year, when I will file my income tax, which option will give me the bigger return? What is the best way to approach companies which own multiple stores around me? Okay, that's another question, I think. I just read it. But let me address this question, the tax benefit part, because he's right. I have addressed leasing versus buying. If you go on my website, gasstationbusiness101.com, you will see a couple of articles just on that, leasing versus buying. And I have addressed it in a podcast episode as well. Since he wants me to address the tax benefit, let's talk about that. Let's take his example that both stores are exactly the same, and one was bought by cash. Lease was bought by cash, the other one by bank loan, and both stores exactly have the same sales. One has a lease payment, one has a banknote payment. And those payments are same. Let's say $7,000 note payment and $7,000 rent. So at the end of the year, when you file taxes, which one will give you a bigger return, right? This is how it works. When you are leasing, your whole lease payment is considered an expense. So at the end of the year, when you file your income tax, you will be able to deduct all that $7,000 from your tax return each month. So 7 times 12. $84,000 can be deducted from your income of that gas station just for the rent purpose or the rent that you paid, because it is an expense, just like the power bill you paid. Now, on the other hand, if you bought the store with a banknote, then only thing you will be able to deduct is the interest that you have paid on that banknote. That is a deductible expense, because IRS or the tax people look at it this way, that you're buying an asset, so you're gaining equity in that business. So you cannot deduct the whole amount, this whole $7,000, but instead you should be able to deduct the interest part. And obviously, on both cases, you should be able to deduct your property taxes and insurance cost and all of those, because those are expenses. But now, let's take a look at the difference. If you use a mortgage calculator, you will see a $7,000 mortgage payment. Most likely at the beginning of the loan, you pay more interest than principal. But let's take a look at typically a $700,000 loan for, let's say, 11 and a half years at 4.5% interest rate, which comes out to about $7,000 a month note payment. I had to just pull out a mortgage calculator for that. And I'm looking at the amortization table. And for this instance, let's say month 1, your payment is $7,000 and your payment will remain the same all throughout the loan. But the first month, you will repay out of that $7,000, $4,100 will go towards the principal. And $2,800 will go towards the interest, which is deductible at the end of the year. Now, a quick look at this situation tells you that you will be able to deduct less from your income tax at the end of the year, right? Well, not exactly, because when you buy a facility such as a gas station, there are so many equipments and other structures are involved that they are subject to something called a depreciation table. And depending on your CPA, they may suggest a 7-year depreciation versus a 9-year depreciation, but there will be a depreciation table. That means the value of the building and the value of your equipment, pumps, canopies, tanks, you can depreciate the value of it because over time they get older and at one point they will need to be replaced. So the government the tax, IRS has a way to offset that for you, which is a beautiful system. So what you eventually do is put it on a depreciation table talking with your CPA. So every year you take a deduction for that depreciation. So you're getting more money back in your pocket. And exactly how much depends on your value of the property, the age of the property, and your accountant, how he or she depreciates that value according to the tax code. So let's say the depreciation brings you another $20,000 or $25,000 a year in income tax savings. Once you add that with your interest, you may save even more. But the sweet part of it is in 10 years or 11 years or 15 years, however many years you have this loan set up, you're letting the depreciation and the interest cost pay for it. And you end up owning that facility free and clear after you pay off that loan, which you did not really pay out of your pocket because the tax deduction and the interest deduction helped you pay for it. So let's say those two deduction adds up to be the same as your rental deduction. Then you can figure out that buying is always and always a much, much better option. No doubt about it. Because as I said, after the loan is paid off in 10 years or 11 years or 12 years, you're sitting on a income producing property that was bought for $700,000, for example, and now the market value has gone up to $1 million. So you're sitting on $1 million paid off property that you paid out of your business without taking money out of your pocket. So you see, the tax benefit is huge. Well, I shouldn't have said tax benefit. Tax benefit is same for both of those, but in one where you buy the property, your tax helps you pay for the whole place without taking any money, extra money out of your pocket. So it is a fantastic idea if you can buy the place instead of leasing. Leasing is always a bad idea because your money is out the window. Somebody else is getting their loan paid off while you just pay them and help them to pay their loan off. I'm sure I was able to clear the confusion that you have about tax benefits. And if you have any more questions, feel free to email me once again. Moving on to your third part of the question, and I believe that was a small question regarding the best way to approach companies which own multiple stores around you. Well, again, be very professional, have a plan, and have good financial records for yourself, and set up a meeting, introduce yourself, and tell them your intention that you're looking to get into this business and you're looking to get help, and you have certain amount of money saved up and you have good credit and you are a stable person, and see if they can offer you something. It is always good to meet face to face. Writing letters, sending emails helps, but not as much. So if you can send an email or write a letter asking for an appointment to meet, and once you meet, be professional, dress well, convince them. Do not talk too much, try to listen more than talking. Let them do the talking. Let them ask you questions. Answer properly and precisely. Do not go into raving and ranting about something, how good you are or how great you are. Don't do that. Be precise and be professional, and you should be okay. Question number 3. Let me read the question first. He writes, "Good morning, Shabbir. Glad I ran into your website. I found a gas station business for sale for $85,000. We did our due diligence to look into the traffic and all other stuff that you mentioned. Mostly the sales are from cigarettes and beer. The other items are pretty much a standstill. In addition, the gas is unbranded. They're selling like 700 gallons per day. Inside the store, with majority of the sales coming from beer and cigarette sales, the sales are about $40,000 and at 35% profit margin. The expense is about $9,500. The profit is about $2,750 a month is what I'm estimating. Not me, but the person who sent the email says he's estimating the profit is about $2,750. Now, his question is the goodwill they're asking outrageous? Currently, the owner is not opening the store properly and wants to sell it. Okay, let's take a look at this situation. Similar to the first one we answered. Again, if he says the majority of the sales are coming from cigarettes and beer, which are the lowest two profit margin items in every gas stations. Cigarettes, as you know, I've said many times that the profit margin has gone down from, let's say, at one point they were as high as 22%. But now most gas stations, if you're competitive, you're doing anywhere from 13 to about 16 or 17% at best. And beer or alcoholic beverages, your profit margin are now about 23 to 24% at the good side and about 18, 19% on the low side. So if $40,000 revenue, I don't think they're making 35% profit, to be honest. And if we calculate even at 25% for $40,000 sale, which I think if they're selling mostly beer and cigarettes, they're not doing 25% margin. I think they're doing much less, but I need to see the exact number to be able to tell you how much profit margin they're making. But if we estimate at the low end of 25% for a typical gas station, that is the average, then the profit margin, the profit dollar, the gross profit should be $10,000 for $40,000 sales. Because if you multiply 40,000 times 25% margin, that's where it comes to. Now, on the gasoline side, he says 700 gallons a day. And I'm guessing they're making 10 cents a gallon. So 700 gallons times 30 days is 21,000 gallons. And at 10 cents, that's $2,100 a month gas profit. So if you add 10,000 plus 2,100, that's $12,100 gross profit from that store each month. And he says the expense he calculates about $9,500. So if the expense is $9,500 and you deduct that from the $12,100, you're looking at right around $2,500 to $2,700 based on which number you go with. So even though he writes 35% profit margin, but I think he calculates the real profit to be more around 25%, not 35%. And it could be lower, as I said, because cigarette and beer both are low profit margin items. So now the goodwill, which is $85,000, is it too high? Well, again, it depends where the store is and how much the other stores are being sold around the area for what other prices. See, it's just like homes. When you try to buy a home, you look at comparable sales. They say comp sales, where you look at other houses that are being sold in the neighborhood or in the vicinity. So you can get an idea how much per square footage people are paying in that area. And then based on your house, the build quality and the area and the age of the house, you figure out, okay, if the other houses are selling anywhere from $95 to $100 a square footage, then I should stay within that range. So that is one way to figure out if the price is normal for that area or not. Now, as for profitability, which is my bigger concern in this case, you need to figure out what their cigarette profit margin is and what their beer profit margin is and how much percentage of sales these two categories carry. For example, if the store is doing $40,000 sales a month, that means they're doing anywhere from $1,200 to $1,400 a day sales. Out of that $1,400 day sale, how much of it is cigarette? How much of it is beer? And how much of it is the other stuff, the chips, the Coke, the drinks, and all that other stuff? Because those are higher profit margin items. But if you see that 70% of your sales come from cigarettes and beer, which are, let's say, 15 or 16% for cigarettes and about 20-21% for beer, then there is no way you're making more than 22 or 23% altogether, maybe even less. In that case, you will not be making $2,100 profit a month. And on the other hand, when you're taking on a headache such as a gas station, when I say it's a headache, because if you're not making money, it is a headache. Because there are a lot of moving parts to this type of businesses, and it takes a lot of time to manage and run one of these gas station businesses. So if you're not compensated well enough, then you're not valuing your time well. So one caveat to this question was that the property owner or the gas station owner is not opening the store properly. So let's say in the event you open and close this store properly or extend the opening operation hour, you may increase the sale by a couple of $100 a day, which may bring you an additional $800, $900, maybe $1,000 extra profit. But at the end of the day, at the end of the month, let's say you only made $2,500. Is that worth it? Is it worth your time and effort and energy to make $2,500? Unless you decide to work yourself behind the counter and you get paid the hourly wages. So in that $9,500 expense, part of it is your payroll. And then the additional $2,500 that you make profit, that's yours to keep. Then I believe it is doable for you. Or it is, yes, as long as you check the profit margin and you see that it is making $2,500 a month, then yes, if you're working yourself in the store with your family member or somebody else, then it might be a good opportunity for you. And that $85,000 asking price may not be a bad one. Again, depending on the area, the location, and comparable sales. But again, my emphasis should not be on asking price, but more on the profitability of the store and the deal you're getting as far as the lease goes. What type of lease will you be signing? How many years of that? Because that $85,000 that you will be paying as a goodwill, is it a 5-year lease? Then it's not worth it. If it's a long-term lease, then it may be worth it, because 5 years down the road, if you don't like the business, you can sell your lease to somebody else. But if you only have a 7-year lease and after 5 years, you try to sell it, nobody would want to buy that lease because there is only 2 years remaining. So if you ask $75,000 or $85,000 at that point, people are going to say, so 2 years later, I can get kicked out of this store and I've paid you $85,000 for just 2 years. So first goal would be to get a favorable lease. Make sure you review that with an attorney. And as long as you get a long-term lease and 2 years, 3 years down the road, you don't see that you like the store, you see you don't enjoy the store, you don't see you're making enough money to compensate for the time and effort that you're putting in, you can sell the store. So again, do not put much emphasis on how much you're paying versus how much you'll be making and how you value your time. Well, we're pretty much at the end of this episode, even though at the beginning I said I will answer 7 questions, but until I got into it, I didn't realize that it will take me this long to answer just 3 questions, because these were loaded questions and I wanted to explain 100% so everybody is clear in what we're talking about. And we talked about many numbers here, so I had to repeat some of these numbers a few times for those of you that are not with a pen and paper can at least comprehend the profitability or the expense and whatnot. So what we will do is I will continue this episode and finish the other 4 questions that I've left to answer in the next following episode, which will be published in just a few days, because we're pretty much at the hour marker right now. And I don't want to make this episode a 2-hour long episode, because that's a painful thing for you and for me both. So let's finish this episode up in the next one, where I will answer the rest of the 4 questions. And if you have any question in the meantime, feel free to send me an email at shabir@gasstationbusiness101.com, or you can post it on my Facebook group page by going to shabirhossain.net. This is a domain redirect that will land you to my Facebook group. Don't forget to sign up for my very important newsletter, which is working perfectly, I might add. And I'm getting a lot of email because I set up a sequence of email that once you sign up, you start getting 1 email every 2 weeks. And these are those 7 very valuable emails: how to find a gas station to buy, how to figure out if the gas station is making money, how to do due diligence, and how to figure out the profitability, how to maintain the gas stations, and all those important basic things. And I'm getting a lot of email people thanking me once they read those emails. So I know you will get benefited from reading those emails, and you can save them. So anytime you are going to buy a station, you can take those notes out and compare whatever you're finding to see how you should ask the question, what you should ask, how you should analyze those numbers and all that. So if nothing else, subscribe to get those emails, and then you can unsubscribe. I will not ask you to buy anything from me for any reason whatsoever. So don't worry about giving out or signing up for my email newsletter thinking that, hey, Shabbir may sell me something or ask me for money. No, I wouldn't do that. So feel free to sign up and just save those emails for any time you're looking to buy a business. I know those emails will help you and guide you to the right direction. In the meantime, if you haven't subscribed to this podcast, feel free to do so, because I don't publish a podcast episode every week. So anytime, if you subscribed, anytime I publish an episode, it will be delivered to your inbox, or you'll be notified that there is a new episode. That way you don't have to come and check every so often. So it is a good thing to subscribe. And most of you that are listening on iTunes or via iPhone or any Apple device, you can just subscribe it on iTunes, and it will be notified or delivered or downloaded into your device automatically. And if you're on Android, and I'm sure there are ways you can subscribe there as well. And if you enjoy my episode, I would love to see a review from you on iTunes or wherever you download this episode from. These reviews mean a lot to me, makes my work worthwhile. And I am adding a link for iTunes listeners to click on that link so you can review my podcast, making it easy for you, because I know it's hard to find my episode's homepage to review that. So if you go to my blog, gasstationbusiness101.com, and click on the very first page, if you're listening in next 2-3 weeks after publishing this podcast, you will find episode number 59 on the very first page or the second page of the podcast page. And at the end of the show notes, you will see an iTunes link, so you can go and also subscribe and put a review for me. Thank you once again for joining me in this episode. And as I promised, I will finish this episode very soon in next week or so. Take care, and I will see you in the next one.
This has been the one and only Gas Station Business 101 podcast with your host, Shabbir Hossain. This podcast was brought to you by CSB Academy Publishing Company. Be sure to join us next time as we share with you the secrets about how to start and operate a gas station business successfully and make money.